Hi, Paul has asked me to do a presentation on target date funds for you. And the way I think of target date funds is as wealth multipliers. So that's the lens we're going to look at them through today. So what is a target date fund? This is an example of a target date fund, and what we're looking at here is called the glide path. This happens to be the Vanguard Target Retirement Date Fund for 2050. Its ticker is VFIFX. And what you see here is a fund that is designed to get somebody to a retirement allocation around what's shown as age 65 on the chart here in the year 2050. And that's the way target date funds work. They usually have a year in the name, and you pick the year that is closest to when you're likely to retire. And what's happening under the hood here is that it starts out with a lot of equities because when you're a young person, you want to grow your portfolio rapidly and you can tolerate more risk because you have more years to recover from any kind of a market downturn. And then it lowers that risk by increasing the amount that are in bonds or fixed income as you get closer and closer to retirement. And in the case of the Vanguard Target Retirement Fund, it continues decreasing equities and increasing bonds all the way into retirement, 7 years into retirement. So we start out at age 20 here, or 45 years before the retirement target date, with a 90-10, 90% in equities and 10% in fixed income. And at around age 40 or 25 years prior to retirement, it starts to decrease the equities to the point that at retirement, at age 65, it's a 50-50 allocation. And then around age 72 or 7 years into retirement, you actually end up with a 30% equity, 70% fixed income allocation. Now, the reason these are so important is that whether you use one or not, you almost certainly know somebody who does. They are the default for many young people in a defined contribution plan like a 401k. And in those programs, an employee will quite often be defaulted when they're hired into putting 3%, 4%, 5% of their income into a default investment, which is a target date fund. And based on their age, they'll estimate what year that should be. They're very inexpensive too. So the expense ratio on the Vanguard target date funds or target retirement funds is 0.08%. So a very cost-effective way to get a dynamic allocation that changes with age and remains somewhat age appropriate, reducing this risk nearing retirement. So a powerful tool, one that I think is wonderful for young people, but what you're probably wondering now is how does it perform? So we will take a look at that. And we'll start by looking at a lump sum. If you look back in time and you just were to invest a lump sum, and I know that's not the way a young person invests, they do dollar cost averaging in, but to keep the analysis simple and compare it to other portfolios that you might see or other asset allocations, we'll just look at how it performed with a lump sum investment. And what we see is that going back to 1970 for the returns and the drawdown and back to 1928 for the safe withdrawal rate calculations, we get about a 9.8% compound annual rate of return, or CAGR. And the worst 10-year CAGR, going back to 1970 for this asset allocation, this is in the early years, so this is for the young person allocation, it still delivered a 1.1% or a positive return, which is good. So that's almost what you would expect from a total stock market portfolio, and that's not surprising because this is a 90% equities, 10% bonds portfolio. Now, it is volatile in these early years. The worst case drawdown was a 48% loss, so about half. About half was the decline from the peak to the trough. That's how we describe a drawdown before it started coming back up. So for a young person who's contributing regularly, they might not have actually seen that full 48. They might have only seen 40% or 44% because it's masked by their ongoing contributions. but it is a part of the ride. And that risk that you tolerate in those early years helps you have a bigger nest egg in the later years. Now, the 30-year safe withdrawal rate may seem like an odd metric to have here for the young allocation because you're not withdrawing any money. But the reason we have that in there is that the safe withdrawal rate is a good indicator of resilience to sequence of returns risk. And so we want to look at all of our portfolios through that lens too. Now, what is a safe withdrawal rate? Basically, that means you go back to every start point that you could have used and you set a withdrawal in the first year. And in this case, it was 4.2%. And then with every successive year for 30 years into retirement, you increase the amount that you take out of the portfolio by inflation. So if you had a $100,000 portfolio, 4.2% would be $4,200. You would take that out in year one. And if there was 10% inflation, you would add $420 the next year and take out $462. So that's what the safe withdrawal rate is, and it's set by the worst sequence of returns for this asset allocation somewhere in the past. Now, 4.2% is a perfectly respectable 30-year safe withdrawal rate. So even a retiree, if they were willing to tolerate these ups and downs, could stick with this same young person allocation. The problem is most of us, as we approach retirement, want greater certainty in the size of our nest egg than plus or minus 50%, right? So that gets to what's going on in the right-hand side of this chart. So we'll go all the way to a mature retiree, somebody who's more than 7 years into retirement, and look at what that asset allocation has done in the past. And its compound annual growth rate, going back to 1970, was 8%. So it's lower because you have a lot more fixed income. And its worst drawdown was minus 17%. So the dramatic change here is that you have far less volatility. And around age 65, that worst case drawdown was close to 25%. So much, much less uncertainty in the size of your nest egg going into retirement and living into retirement. Now, if there's a red flag about this allocation, it's that the 30-year safe withdrawal rate for this highly conservative allocation that you get to at age 72 is only 3.5%. Now, why would somebody who's managing a target retirement allocation for people be okay with a 3.5% safe withdrawal rate when most people usually think of 4% as a traditional safe withdrawal rate? Well, the reason is that this is 7 years into retirement. So most people, if you look at actuarial tables, probably don't have 30 years left to live. It's sad to say, but by the time you get to 72, most of us aren't going to live to 102. So they're probably okay with that 3.5% because if you looked at it as a 20 or a 25-year safe withdrawal rate, it would be higher. It would be back up to around 4. So that's what's going on. Basically, you have this asset allocation that's acting in some ways like a robo-advisor for somebody in the background. And all you do is you invest your money, you hold that same account for your whole life, you take money out on the other end, and it works for you. Now, you can see what we've basically described here is on the left-hand side, you have high risk and high reward. And on the right-hand side, you have low risk, low reward. And that asset allocation curve that's showing that transition is called the glide path. But what most of us want to know is how is that going to perform for us across a lifetime? So to do that, to come up with some kind of way of analyzing that, we need to look at a scenario. And the scenario I'm going to use is somebody who works for 40 years, saves 10% per year, and at retirement takes out 4% in the first year, and every year thereafter increases that 4% dollar amount by inflation so that they're basically living off a constant real purchasing power in retirement. And after 30 years in retirement, they leave a legacy. They leave a legacy to someone else. And we're going to use these same periods of time. So we'll calculate the returns and the drawdowns based on 1970 to 1922, and we'll calculate the safe withdrawal rates based on 1928 to 1922. And the reason we use these different time frames is that between 1970 and 2022, we have a fairly complete set of asset class returns that lets us model the portfolio fairly accurately. But the worst safe withdrawal rates are often set by some sequences of returns that happened in the 60s. So we approximate these asset allocations going back to 1928 with the most similar assets that we have. Unfortunately, they're mostly US. We don't have as many international assets. And then we use that to set the safe withdrawal rates, just to be conservative is the way I like to think of it. And remember, safe withdrawal rates are set at the worst possible time. So the vast majority of times when people could have retired, they could have taken out more money. But it's not the actual number that's so important, it's relative size. The bigger the safe withdrawal rate, the more resilient these portfolios were to sequence of returns risk. And that's the way I want you to look at them. So let's look at this reference lifetime scenario with an all stock, all the time asset allocation, the S&P 500. So what we have on the left-hand side is a stack that includes the 90% spent. So if you earned $100,000 a year as a family, and you will say two incomes of $50,000 each, and you earned that for 40 years, that would be $4 million. And if you saved 10%, that would mean that you set aside $400,000 in your investment. And what we have on the right-hand side is what that would have turned into with an S&P 500 100% stock allocation using the periods of time that we just described. And it's amazing what happened historically as a median result is that you would have multiplied that $400,000 by 150 times. Now, if I show this chart to a young person, they're not going to decide to save 10%. They're going to wonder why they need to save more than 1%. There's a problem with this chart, though, and that problem is that this is nominal returns. The money you have after 70 years of investing on the other end isn't worth nearly as much dollar for dollar as it is at the beginning because inflation erodes its value. So instead of nominal returns, let's look at real returns. And what real returns are the returns you get after we take out the effects of inflation so that the dollar at the end has the same purchasing power as the dollar at the beginning. And when we look at it that way, the lifetime scenario with the S&P 500 has an 18 times multiplier. It's very respectable, and it's a fine solution for somebody with nerves of steel. And why do I say nerves of steel? Well, you have to tolerate a worst case drawdown of 57%. So that means, let's say you've been working for 20 years building up your nest egg, and you've finally gotten it to $1 million, and the market takes a turn for the worse, and it goes through a downturn. With the S&P 500 going through this brief history back to 1970, the worst case drawdown was 57%, which would mean that you're only left with $430,000 of that $1 million nest egg before the market turns around and starts coming back up. And if you lock that loss in, you're never going to get this 6.7% real compound annual growth rate that you hoped to get because you won't know when to get back in. And so you have at that point exceeded your risk tolerance from a behavioral standpoint, which is absolutely horrible. The other thing is that this risk is throughout. It's not just in accumulation, it's also in retirement, it's nearing retirement. It is a very bumpy ride, and this portfolio is not very resilient to sequence of returns risk. It only has a 30-year safe withdrawal rate of 3%. So people could potentially succeed with this, but very few of them would want to because it's such a bumpy ride with the bumps all coming throughout, whether it's a good time or a bad time for those bumps to show up. So instead, let's look at what the Vanguard target date fund did, again, on a real basis across these same histories. And what we see here is that the multiplier, the wealth multiplier of the 10% that's invested to what you have to spend in retirement and leave as legacy is only 8 times. And 8 times, that doesn't sound like a lot. But remember, we're taking a lot less risk, and you can see that down here in the drawdowns. So there's about the same drawdown, 48% in accumulation in the early years, but nearing retirement, you're down to 27%. So now, 5 years from retirement, instead of having to have twice as much money as you might need to retire just because you don't know if you're going to lose half of it in a market downturn, now you only need to have 30% more. Or put another way, if you have just enough to maintain your lifestyle and you think you could live on 27% less, by cutting some corners for a year or two to get by while the market recovers, you're okay with this allocation. And the safe withdrawal rate is higher at 3.7%. So it's a more resilient portfolio. And the other thing is, looking over on the right-hand side, it's more balanced in terms of how you spend your money. You spend more of it while you're alive and pass less of it on to heirs. So would an 8% real multiplier be bad? Remember, we were saving 90% of our income in our working years. It turns out that the target date fund, using 4% withdrawals, had median withdrawals that were equal to 68% of the pre-retirement income. So almost 70% of the money that you were spending pre-retirement, you would be able to spend just based on those 4% withdrawals. If there was a 10% employer match, that bumps that up to 75%. And if there's Social Security, that likely adds more. So I think for many people, this would provide a very comfortable retirement. And at the end of retirement, the median real legacy using this approach, just a target date fund, was equal to approximately 10 times the pre-retirement annual income. So for the average investor who's not willing to spend time and energy to learn about personal finance, to learn about asset classes, to learn about tracking error, I think the target date fund is really, really well designed and ideally suited. It manages risk approaching those nervous Nelly years getting into retirement. And it does it all in a way that delivers enough growth for somebody who works a large number of years and saves a prudent 10% per year to live a very comfortable life in retirement. But I hear many of you who have watched Paul's work before say, could we do better? Couldn't we do better than this very conservative approach? And the answer is yes. And the approach that Paul and I like to advocate for doing better than a target date fund, we call 2 funds for life. And effectively what we do here is we take the very conservative target date fund and we augment it with an asset class that has a history of delivering higher returns in a way that is not synchronized with or lockstep tracking to the assets that are in the target date fund. So the asset class that we recommend is US small cap value. And we recommend that asset class because it's available, it's inexpensive, it has a long history of academic research pointing to its higher return potential and expected return. And when combined with the target date fund, it delivers these greater returns without a substantially greater amount of risk. And the simplest way to do this is to take 9 pennies out of every dollar that you're going to make. So 9 pennies out of every dollar you're making, you're going to put into the target date fund. That's 9%. And the other penny out of every dollar that you make, you're going to put into US small cap value. And you're not even going to rebalance during your years of accumulation. And when you get to retirement, you're going to take 4% fixed withdrawals. Now, what that means is you take 4% of your nest egg in year 1, that's your withdrawal. And in the next year, you figure out what inflation was and you increase that 4% withdrawal by inflation. And by doing that, you have a constant purchasing power through retirement. And since we haven't rebalanced to this point, to getting to retirement, we're going to have these 4% withdrawals be nudge withdrawals. So we're going to take that entire 4% out of whichever asset class is bigger than it's supposed to be. So if US small cap value is 11% instead of the 10% that it was supposed to be, we'll take all 4% out of US small cap value. Now, I hear some of you saying, wait a minute, you're going to overshoot. Now you're going to have less than the 10% that you were supposed to have. That's true. The nudge withdrawals do overshoot, and if you wanted to get fancy and you wanted to, do the calculations to equal it out every year, you could do that too. But we're just trying to keep it simple and see what ends up happening. And what ends up happening is that instead of an 8 times multiplier, we get an 11 times multiplier. So historically, this definitely helped. The difference between multiplying your savings by 8 on a real basis and 11 is pretty substantial. And it did it with only a little bit more risk in accumulation. You went from 48% to 49%. And the worst case drawdowns nearing retirement do go from 27 to 35%, but I think that's totally manageable for a lot of people. And the reason they go up so much around nearing retirement is that the small cap value without rebalancing may grow to be a larger part of the portfolio than the 10% that you've been investing in it. It probably will. And that's where these nudge withdrawals kick in when you get into retirement, because once you're in retirement, that first withdrawal of 4% is going to knock that extra small cap value down, and it'll continue doing that until you start withdrawing from the target date fund. Perhaps the biggest surprise here, though, is that the safe withdrawal rate also goes up to 4.1%. And why is that? It's because of this lack of correlation or synchronization between the assets. So instead of the small cap value going up and down in lockstep with the rest of the assets in the target date fund, it tends to move a little bit differently. And that means that we're getting a higher return per unit of risk and a greater resilience to sequence of returns risk, which is exactly what we want in retirement. And we want that actually throughout as much as we can. So if 10% helps, what about 20%? Well, 20% helps a lot more. So instead of an 11 times multiplier, we had a 15 times multiplier. We're almost back to the 18 times multiplier of the S&P 500, which was all equities all the time. But the difference is we still have declining risk approaching retirement. The worst case drawdown near retirement here was 42%. Again, that's probably because the small cap value on average has grown to be larger than 20% of the portfolio nearing retirement. But the safe withdrawal rate is 4.6%. So higher still, a very resilient portfolio. And the legacy here is actually bigger than what you get to spend in retirement. What does that mean in practice? I think what it means in practice is that somebody who's 10 years, 15 years into retirement will look at the size of their portfolio and say, I have an option if I want to be more generous with my heirs or with charities. I clearly have more money than I need. And that's not a bad problem to have either. So at this point in the presentation, it's not unusual to have the hyper enthusiast in the corner say, well, what if you dial it to 11? What if you go 50-50 in the target date fund and small cap value? And before you lean back in your chair and think that's too extreme, those of you who followed Paul's work know about his ultimate buy and hold portfolio, which is half in large, half in small, half in blend, half in value. And it is a prudent investment approach, especially when combined with the right amount of bonds. And remember, the target date fund is adding bonds as you age. So what would happen if we did a 50-50 allocation and we did it rebalanced annually? Well, the multiplier of the money that was invested using this approach was 31 times. So way better than the S&P 500, but with much less risk. So the worst case drawdown in the early years is comparable to the S&P 500 at 54% instead of 57%. So it's still lower. But the worst case drawdown nearing retirement is 44%. So quite a bit lower than the S&P 500 all by itself. and actually not that different than the 80-20. The 80-20 without rebalancing was 42%. And the safe withdrawal rate is the highest safe withdrawal rate we've seen yet at 4.7%. And once again, more of the money is going to be in legacy because you're simply not taking out enough, is the way I like to think of it. I mean, if a portfolio has a safe withdrawal rate of 4.7% and you're taking out 4% per year, you're going to have a lot left over. So using this approach, provided it doesn't exceed your ability to stay the course, gives you the ability to be more generous with yourself or with others in your retirement years, which I think is also very powerful. So earlier we looked at the back tests of the left-hand side of the curve and the right-hand side of the curve. We've also done back tests for all of the asset allocations at key points, the key 5-year points along the curve. And we've done that not just for the target date fund, but also for the 90-10 allocations, the 80-20 allocation, and the 70-30, the 60-40, and the 50-50. And these are available at Paul Merriman's website, paulmerriman.com. On the portfolio configurator, if you go to the left-hand side, there are some tabs, and you can find the tab for the 2 Fund for Life fine-tuning table. And using this tool, you can further customize and look for what allocation is going to give you a high compound annual growth rate, a lower worst case drawdown, or a higher safe withdrawal rate, or all of those things, or which ones have an asset allocation similar to the ultimate buy and hold portfolio. You have a lot of choices here. So in summary, investing is really powerful for a young person. It can double, triple, or quadruple their real inflation-adjusted lifetime spending power. And it doesn't have to be complicated. A target date fund is fine, and it's the simplest solution, and it smooths the ride when it matters most. But for investors willing to learn and willing to stay the course, adding some small cap value improves expected returns and safe withdrawal rates. And you have choice. You know, the most amazing thing about the world we live in today is how inexpensive these powerful tools are and how available they are to so many people. So I hope that this is helpful. I hope that it's useful to you and can help improve your investing experience. I hope you can share it with people, maybe young people who can also benefit from it. And if you or they want to learn more, you can go to paulmerriman.com for books, articles, recommendations. You can sign up for the free newsletter, and you can get Paul's excellent We're Talking Millions. You can get my deep dive into 2 Funds for Life, or Paul Hayes' Spending Your Way to Wealth. And just to close this out, remember that everything in this presentation is for information, education, entertainment. We are not your advisors. And if you do need professional advice, we encourage you to go get it. And with that, I thank you for your time. I thank you for your attention. And again, I hope you'll share this with somebody, and I hope it will improve your life or the life of those you share it with. Thank you.